debt-laden companies may soon get a lifeline as discussions are underway between banks and RBI to hammer out a new debt restructuring plan. Latha is now joining in with more details. Latha, what is this new sort of process that RBI and banks are now looking at?
Well, what we understand is that a lot of good assets can be made viable if their huge debt is reduced in some fashion and everyone all around takes a hit. So the plan that is underway is to take each case, separate the unsustainable debt from the sustainable debt, transform the unsustainable debt in such a way that both banks and promoters take a bit of the hit. That is, the banks convert that part of the loan into preference shares, which will earn very little, probably 1 or 2%, and promoters convert part of that debt allow a part of the debt to be converted to equity. So if it's a 2,000 crore hit that you are taking as unsustainable debt, 1,000 crore becomes preference shares, 1,000 crore becomes the equity of the company. So if the company were to revive, banks get the upside as well. However, the process will also have to be accompanied by a very robust system which ensures that the promoter has not siphoned money. So a forensic audit, etc., have to be done. The process has to be vetted to ensure that unscrupulous elements are not taking advantage. So all these are the elements banks and RBI are looking at. 1, to divide the debt, 2, to ensure that the hit is equally divided, 3, to ensure that the process is robust, and 4th, what we have been talking and Nisha broke as a story, that 2 funds be set up outside, because banks are unwilling to lend money. So a stressed asset equity fund and a stressed asset loan fund be set up along with private equity and banks, which will throw the lifeline in terms of capital and loans.
Okay, all right. Thanks so much, Latha. And that explains why a lot of those heavily debt-laden mid-cap infrastructure stocks are still positive in a market which is struggling to find